Audrey.
Good morning, everyone. It is Mortgage Pros 411. I am Audrey Boissonou. I'm here with my co-host, Kevin Casey, and we are joined today by Michael Williams. He is the lobbyist and the head of the Williams Group in Washington, D.C., who lobbies on the mortgage industry's behalf. Welcome, Michael. Thanks for joining us.
Thank you, Audrey. Thank you, Kevin. Glad to be here.
We've had the pleasure to be in Washington, D.C. the last few days. It has been, as always, very interesting. Yesterday was quite the lineup of different speakers from different parts of the industry, different parts of Congress. And then today we went to the Hill where we had even more exciting events happen. So let's just start with briefly. We had who did we hear from yesterday? We heard from Representative Patrick Mahinry, and he is the chairman of the House Committee on Financial Services. We were joined by Anthony Hutchinson, who a lot of you might remember from Freddie. I used to debate with him quite a bit about his algorithms that he swore Freddie priced their LLPAs off of. And I said they were a bunch of bupkis, and he insisted that they were for real. And now he is with Vantage Score. And so yesterday we were so happy to see each other, and I told him I'd be grinding them on Vantage Score's algorithms too. But this time, apparently I get to talk to whomever does the algorithm. So it should be interesting. Looking forward to that. We heard from Jeff Markowitz, who is Deputy CAO and SVP External Relations and Corporate Communications at Freddie Mac. He's a great guy. Julia Gordon, also, we love FHA. They're so transparent and open. Julia Gordon is the Assistant Secretary of the U.S. Department of Housing and Urban Development. Then we heard from our guest, Michael Williams. Then we were joined by Sandra Thompson, and she is—
Who's Sandra Thompson?
She's the director of the FHFA. Remember her? Last year, she was the acting director. This year, she's actually the director. So we heard from her. Then we were joined by Representative Richie Torres out of New York. And we had some exciting things go on. So we're going to start with that, shall we? So Representative Torres was the person who dropped the trigger lead bill yesterday in Congress, and it is, just in case you want to follow it, HR 2656. Michael, this is great news, right? But what happens from here? This trigger bill is introduced, and then what happens?
Well, this is the beginning of the beginning for this Congress. As you know, Audrey, the bill was dropped last year. Right. He was not able to get a Republican co-sponsor on that bill, and it did not go. He has actually worked a lot smarter, not harder, this year. So he's actually had conversations with Republicans prior to dropping the bill. And we are confident that he is going to be able to get one. Specifically, Warren Davidson from Ohio, who is this year the chairman of the Housing Subcommittee on Financial Services, which is a big get, right? It's important. That's where the bill would actually proceed through the committee before it gets to the full committee, where Chairman McHenry would have to make a decision on whether or not to bring that up. We've had conversations with Maxine Waters' staff. They've worked closely with Richie Torres on the bill itself to make sure that all of the provisions are matched up from a legal perspective and from a policy perspective as well. So she is on board with the provision. We have no doubts that Democrats, by and large, will be supportive. The key question at this point is how many Republicans can we get engaged on this matter? So again, Congressman Torres has been working hard on that side to get as much support as possible, but it's dodgy. And I don't think it has anything to do with the policy itself. It has more to do with the nature of the House. Given the fact that it's so tightly divided and there's so many issues that are under consideration right now, not to mention, important things like the debt ceiling, funding the government, Social Security, Medicare, and all of those weighty issues certainly will have a downward effect on the ability for this to rise up. But again, with committed bipartisan co-sponsors, I think that we could actually see some success on that provision by the end of this year.
We're going to come back to some of those issues you just mentioned in a little bit, but I would just like to throw it out there to our listeners right now. If you have any sort of relationship or know about a congressperson who would be interested in co-sponsoring this bill from the Republican side, please let us know, because it is imperative that you have bipartisan support on these things to get them through. I don't know how Kevin can comment on this too, because when we went and met with our Congress people today, there was a different, it feels like it's a different vibe when you're talking about trigger leads. A few years ago, there was a lot of resistance.
They didn't care.
Right. Or
Yeah.
they didn't really understand. They're like, oh, it's good to have competition. It's good. All of that's great. Now they understand you've got a huge privacy issue. You've got big problems going on with the fraud around trigger leads, with the misrepresentation by a lot of the phone calls being made, the text where, borrowers are being led to believe that they are talking to their lender, that they have thought they thought they were going to do their loan with. It is crazy. So Kevin, I mean, you're feeling the same thing, aren't you?
Oh yeah, no, and we got it last week on our show with Mark McCardle from the CFPB, and he was saying, hey, if you hear from your clients that are getting these scammy calls, give them the CFPB's complaint information, because they are definitely investigating these guys, because it is fraud, and we don't want these fraudsters out there.
Exactly. And I talked to him a couple of times since then too, and it sounds like the CFPB is going to take a stab at this in terms of they understand now that some of these trigger leads are offers of credit, and they're not doing it properly or compliantly either. So there might be an angle for the CFPB to come in and work on this as well, but it's really important to pass this legislation. So we'll keep you posted on what's going on in Congress and how that goes. You let us know if you have some sort of contact that might be helpful in this fight, which is for our consumers. It's for our borrowers. It's not for us. So it's very important that you guys all participate. So anything else to add on that one, Mr. Williams?
No, I think you've covered it.
We covered it, Kevin. That's good.
Yeah, well, actually, one little thing, this is one of the comments from one of the aides that we spoke to. It goes, this one seems like a slam dunk, but there's no such thing as a slam dunk in Congress. That it's only one person, one senator, one Congress can hold up a bill sometimes if they just don't think that they think their bill is more important. They're going to push that bill forward. So it doesn't matter how many people are getting hurt. So it's really just, you got to do it with overwhelming odds in order to get these bills passed.
Exactly. And Michael, let's talk about that for a minute, because again, the idea that consumers' privacy is a political issue, that data being sold without our permission is a political issue. It's so frustrating to me. And we see this as the mortgage industry has become so politicized in the last, maybe it was politicized long before I was involved, but it is so political. And so what happens is we all have to adjust to whatever's going on. Then we have a new administration. It's like some whipsaw back to, okay, is it harder? Is it easier? But whatever it is, it doesn't matter whether it just got harder or easier. It's change, right? Change is expensive. All of the regulations without an eye on what is the ROI, right? An eye on the ROI. That's probably a terrible way to put it. But again, I mentioned this to the CFPB where I'm like, okay, at some point, when do you start asking, you think this is a good idea and it's great in theory, we're going to implement this rule, but how much is it going to cost everyone to implement it on the ground in their businesses? And then how much of an effect is it going to have with the consumer? Is it going to really help them? Or does it just make someone feel good somewhere? So my point is there any chance we could make mortgages less political? Or are we just stuck in this grind?
I don't think it's mortgages per se. I think everything is political. And, to Kevin's earlier point, it seems like a slam dunk. There are many of these ideas, right? Who is against kittens and puppies and,
Right.
sort of, and providers
And if
of
it
the
doesn't
American
cost anybody
dream.
anything,
Exactly. Exactly. And, there's so many bills that are free and they're just sort of conceptual ideas. I think it's the process itself that is broken, and the mortgage industry just happens to be caught in the middle of it, like everyone else, right? Who's against seniors, but somehow there hasn't been, despite multiple commissions, there hasn't been a real solution that's been proffered to fix the Social Security system, right? And to fix Medicare system. No one dislikes the poor, but there are no programs that are being put forward to fix that. And a lot of it has to do with the picking of sides that is politics du jour. And unfortunately, the mortgage industry is caught in there. And Fannie and Freddie they've been in conservatorship now for going on 15 years. And you'd imagine that is something that would be in the best interest of both political parties. And we've had Republican and Democratic administrations during that time, but somehow they remain there. And again, that is a political decision because, as we all know, those G fees have become a piggy bank and no one wants to give that up. No one wants to say that, but that is the truth of the matter.
Well, okay, so one of the things that I thought was promising, not to beat this to death, but I was looking at MBA's talking points, the Mortgage Bankers Association, and they'll be on the Hill tomorrow, and they have trigger leads on their talking points, which, you know, there has been a little pushback at times from servicers because they don't want to give up the ability to retain their servicing clients, right? So if there are trigger leads, then they're alerted, hey, this person is thinking of refinancing or doing something to pay off the loan. And so they want to know that so that they can get in front of it and maybe save that deal from leaving their servicing portfolio. So if we're now all at least on the same page, and you know, the last option on the list for me is we carve out servicers and let them continue to have their trigger leads, but stop the selling of them by the bureaus. That I guess would work in some sense, but I would prefer to just see it go away all the way personally. But NBA, if they're backing it too, that's good news for us, I think. Do you agree?
I mean, it is, and I don't think the servicer issue should overly complicate matters. But as we just discussed, it doesn't take a lot, right? It doesn't take a lot to sort of tip over the house of cards. So I hope not, and I think that's something that we're going to have active discussions on. And given the construct of the Torres bill right now, where it is an affirmative opt-in as opposed to the consumer having to opt out.
Right.
I think that it actually fits pretty seamlessly to exclude servicers from that. You just have to make sure that the definitions are right and that you're sort of thinking, a decade into the future on that to make sure people don't, it's not too broad where you allow some of these fraudsters to be able to come in and slip in under that inadvertently.
Right, exactly. Well, it'll be complicated no matter what happens, but at least we're on the right track, and with with any luck, we'll be able to push that thing forward this year. Okay, so there is a request for a legislative change to expand the small creditor definition. So this is around the fact that brokers were excluded from the small creditor definition, which is why the 3% rule is so egregious and such a problem. So do you want to talk about that for a moment, please?
Sure. This has been around. This is coming out of Dodd Frank, and it's been around for a while, and talked about it round or flat. You talk to members and they say, well, we've given sufficient regulatory flexibility for the agencies to deal with this. And you talk to the CFPB and they say, nah, we don't think that we have that. And that has been the 14-year conversation that's been going on around that particular provision. I think the CFPB certainly understands, again, regardless of administration, regardless of who's in the director's seat, they understand that this is a problem, but they just genuinely don't believe they have the authority to do it. The problem is you have to go back into Congress. And again, just keep beating this dead horse. That's always problematic to do, even on things that actually make sense. I had this conversation this morning with Maxine Waters' staff, and they were just like, wow, okay, that seems ridiculous. Like, who did that? Like, well, you did that. Like, wow, okay, that's we didn't mean to do that. Like, yeah, and here's the unintended consequences. You are taking away our ability to make loans to low and moderate income families. So when you say that you want to do affordable housing, but at the same time, you're excluding mortgage brokers from playing a larger role in that process, you can see where the problem is. And their question was, well, how many people are we talking? How many people are we talking about? Like, how many companies meet this sub 500 threshold? I'm like, well, let me tell you how many people probably do meet it. I don't know, 5, 6. So if you take that and you look at all of the mortgage brokers across the country, that's a lot of, arms and legs in the communities making these loans. So I think for the first time in a long time, they seem to have gotten it. Now, whether or not that leads to legislative action that is necessary to make the modification, I think that that's a little bit of a longer tail. And we're just going to have to work that thing hard, because it's important to note that a full 63% of the current Congress was not here when Dodd Frank was enacted.
Oh, wow.
Wow.
Well,
Yeah.
that's good
Members.
and bad, right?
Well, yes. You have less people who are just sort of, dug in on the position, but you also have an equal number of those people who really don't understand
Yeah.
the nuances, and what they have been indoctrinated on are either I am just 100% for Dodd Frank because Wall Street did this thing, back in 2008. And I am completely anti it because it was an Obama administration initiative. And trying to clear that morass out and get to the heart of the issue, particularly on something as specific as a 3% rule, it's a little difficult.
Mhm.
Well, we were
Yeah.
noticing this morning in our conversation with Nancy Pelosi's office, a very similar response. And it was interesting because we were talking about how she said, well, why was it like this? Why is this such a big deal? And the answer in my mind is that after the meltdown, I refuse to call it the Great Recession, just for the record, Michael, you don't know about this, but it's a thing for me. It was not great. It was a meltdown. So after that happened, brokers were really blamed for it. I mean, Wall Street was under fire for sure. And they were told that they did certain things, but they blamed the mortgage broker.
Yeah.
And
When we
so,
went to Congress those years afterwards, we were told, we don't
yes.
even want to talk to you. You guys
Yes.
caused all this.
It was really uncomfortable for a long time because we were dealing with the aftermath of that. And so the fact that 63% of those people don't remember that is maybe part of what Kevin and I are now experiencing, which is we go in and they're very interested in what we have to say. They want to understand, they seem to, what they're legislating. And so it is really, really good. And so if that's the case, again, we've gone back year after year after year after year talking about the 3% rule. And this time we're talking about a small wording change on a definition. I think it might be an easier fix. And just to take a second, I just saw a pop-up from a listener who said that they wanted to listen. Are we going to send this out? And where you can watch this after today is you can go to our website, Mortgage Pros 411. And there's a link to YouTube where you can watch our videos. There are videos. The only thing we can't post there are the CFPB videos. And so all else is here on our YouTube channel. So you'll be able to, if you have to leave or if you wanted to share that with someone, which is what I'm seeing, then that will be available to you later. So anyway, so yeah, so this for the brokers in the room, we explained also to the person that we were talking to in Nancy Pelosi's office, how this really impacts the borrowers and has zero to do with increasing broker income, because that was kind of the drumbeat for a long time too. Oh, you just want to make more money. No, it's a completely different set of rules for independent mortgage banks and banks, and the broker gets lost in the shuffle, and the broker's critically important in the sense that if a borrower doesn't fit into the box created by a bank, they have to have access to other options. And this is it's a stopping point for a lot of borrowers. So with that, anything else, Michael, on that?
No, not for me.
All right. So let's talk about the Great Flood. So I'm just kidding. Flood insurance. We talked about this last week because Rob Chrisman had a bit in his commentary, and he had pointed out that 90% of the natural disasters in the country had resulted in some sort of flooding, and that it had cost the country $50 billion thus far to fix all that. And so flood insurance is, Kevin, you were talking about this morning. What was the number on how much the fund is upside down?
It's 20 billion. So even though they spent 50, they're only upside down by 20 billion.
Oh,
So it's
well.
not a, so it's minor little
I mean,
thing.
what's our national debt, Michael? It's like
31.4 trillion.
There we go.
31.4, which works out to be $982 a month per person.
Thanks, Kevin. Just
You're
wait
welcome.
for it from Kevin. Kevin
Or
is
$249,000 per
So-
household, per household
Yeah,
across
see, you got the
America.
numbers too. It's a huge
yeah.
number.
So bottom line is there are a bunch of different bills in Congress right now around flood insurance because we've had enormous increases in the cost to the borrower. And it's made properties unaffordable for a lot of borrowers who were living there, and their flood insurance went from $1,500 a year to $5,800 a year, or even worse in some cases. And so we're talking about how there is a guy on the NAM board, Ross Miller, who has been all over that. And I know he's been working with you. So talk about flood insurance for us.
Well, I will make it simple for you. It's political.
What?
So yes,
What?
it is.
That's
So
crazy.
you have Republicans and Democrats who want to address this issue, right? Particularly in areas that are flood prone, either because they're low lying, like Louisiana, the folks that are along the Mississippi, even all the way up to Minnesota. But then you also have East Coast with hurricane and nor'easters up in New York. So you have Democrats, Republicans across the board. Everybody wants to address this problem.
Right.
The issue is fundamentally political in the sense that from Democrats' perspective, they feel that this is, rather than do a bunch of emergency appropriations that are not paid for anyway, why don't we just fully fund the flood insurance program and put them on the government balance sheet so that you can redo the maps, and you can redo the maps, and then you can also fund what is necessary and charge people. And if you have more people participate in the program, that's going to drive the premiums down. But
Correct.
the maps are old, they haven't been redone, and FEMA is severely underfunded. So how is this supposed to work? From a Republican perspective, they do not want to pay for that. They feel that it's just be a market-based solution. And if you redo the maps and there are more people who are participating, then the market forces will take care of it itself. So that fundamental disagreement continues for, I don't know, probably the past 12, 13 years. And what we've gotten is essentially a continuation of kicking the can down the road. And so they just do a 1-year reauthorization of the program.
Right.
No new money is added, no modifications are done. And then we start over again next year. So, last time they did this last year, they did it in December, right? So they did a temporary extension because it expires September 30. They did a temporary extension, and then they did a full year extension in December. I expect that that's what's going to happen again this year.
We have a situation right now, and Kevin actually had a really good example of this for himself personally. Maybe you could take just a quick, can you tell them what that was really quick? I mean,
Real quick,
he bought his place at zero.
So I bought my house. It has a little tiny creek that cuts through one little 4-foot section of the property, way below where my house is, and my house is elevated up. My house will never flood, basically. And when I first bought the house, I was told, you don't need flood insurance because your home will never flood. Then the rules got changed. And suddenly, because I had a creek going through my property, I fell under the rule, and I had to get flood insurance. But it was $250 a year. It's fine, $250 a year. I'm not going to pay it. No big deal. Then they changed the rule again, and they said, oh, no, you don't have to have it if you fall in this category. So I mistakenly said, okay, well, let's waive that insurance. Now, just to note, if I'd kept the insurance, I'd have kept the $250 a year thing. But now I had to go back and get flood insurance, but I also had to get a survey done. Now, the survey cost me $3,000, but that wasn't the worst part. The worst part was there was a 2-year waiting period to get a survey because there was only so many surveyors. Fortunately, I knew someone in the industry, and I was able to get it done in a year. But in that whole year, I ended up paying $1,000 in forced flood insurance by the bank. So, that was a nice little experience. Now I'm paying $1,800 a year. And, I'm hoping they'd be able to keep that $1,800, even though my servicer changed and they let my policy lapse, even though they're supposed to pay for it. And I'm being told that because it was lapsed, I might have to go to the new rate, which is closer to $5,000. And this is me, someone who is never going to file a flood claim.
So the argument is we have a lot of flooding this year, and we are expecting a lot more flooding this year. I mean, in California in particular, we've had massive amounts of rain and snow. So there are places flooding that have never flooded before. But again, his up on a hill. So unless there's like a tsunami that, pops up, that's probably not going to happen. With that being said, we haven't had a consistent flood insurance since when? 2012, Michael? And so I just don't understand how flood insurance gets politicized, but here we are, right?
Well, and here's the point I pointed out about the flood insurance to the legislator was, if you are in a place where your flood insurance goes from $1,800 to $5,000 a month, your flood insurance is required to be paid through the lender. And if you can't come up with that extra $500 a month, guess what that means? It means you are defaulting on your mortgage, okay? And how quickly after you've not made that first payment, second payment, third payment, now you're in foreclosure?
Yeah.
That's a big problem. And so, Michael, what was the solution we came up with for our proposed bill?
Well, it's actually a temporary program, right? So it's a 2-year program that you actually have, in fact, you stop FEMA from doing what it's doing right now, sort of implementing its wacky program and actually turning the authority over to HUD. And so you take it completely out of FEMA and you have the program, this pilot program administered by HUD, which would directly lead to lower premiums for people who are designated in flood zones. Now, you wouldn't need to redraw the map, but this is a real demonstration project that you could do this, that it is possible to make this change. Now, whether or not that actually frees up the fight over, fiscal responsibility versus, just put them on the government balance sheet, I don't think that materially helps, but it does. What I have found is once you actually get a program like that in place, even if it's temporary in nature, and ours would be for 2 years, they tend not to go away. And so while they figure out the politics on the larger flood insurance issue, there will still be some measure of relief. And again, take this out of FEMA, because FEMA is a much leaner agency, shall we say, than HUD. And so when it comes to putting your balance sheet, the agency's balance sheet on the line in years where there are sort of, a prodigious amount of flood events and the Congress won't directly fund them, we like the idea that HUD has the ability to reprogram much more money than FEMA would be able to.
Well, meanwhile, Bandcamp, Louisiana is suing. Who are they suing? NFIP or FEMA or everyone?
They are suing FEMA.
FEMA.
Wow.
Okay. So we'll see if other states jump on board with this idea. And then the flip side of that is, Kevin, do you remember the CFPB saying that perhaps houses shouldn't be built or rebuilt in flood zones? Remember that comment?
Oh, yeah, I've heard that comment before.
That was interesting. I told him, just stop. Don't even say it. So it is, because how do you even manage that? Holy guacamole. So,
well, I know they're doing that to some extent. I know in a lot of the Gulf Coast states, I experienced it here in California near the Russian River, where if you have to rebuild after a flood, you're required to put your home on stilts, basically. And I know they're doing it on the Gulf Coast also. So, it's part of it, part of the solution. It's not a pretty solution, but it works.
Yeah, and stilts never give way, so that'll be fun to watch. So the final talking point that we had going to the Hill before we get into a few other things were the enhanced benefits for Gold Star spouses. And frankly, veterans benefits are something that a lot of people, it puts a smile on your face. Of course, who doesn't want to help a veteran? So Michael, tell me this isn't political. Is this political too? or isn't
It
it?
is largely not political, right? No one's mad at
Good.
the vets, right? I would put
Hallelujah.
them in the puppies and kitten
That's
category.
right.
However, this measure passed last year in the House, and it still didn't get signed into law. So,
Why? Why,
um,
Michael? Why? Explain yourself.
well, because I mean, the Congress passes over 3,000 pieces of legislation every year, right? Either through the House or the Senate. The combined number that actually passes both are maybe 5% of that total.
Wow.
And so it's just inertia, right? And so
Yep.
no one is mad at the vets. It's just a matter of, okay, you get and this is a broadly bipartisan bill that got overwhelming bipartisan support. We've had conversations with the sponsor. They're open to making modifications to actually make the provision a lot more generous from our perspective. But I'm not going to sit here and tell you that it is going to get signed into law by the president. I think it will pass the House again. And the question just becomes, what is the vehicle? I mean, the legislative process, I should say, is just fundamentally flawed, right? Where, we've all seen the Schoolhouse Rock, how a bill becomes a law. That just doesn't apply anymore. So you can do all of the things and take all of the steps, but ultimately, what happens is at the end, everybody wants to get all of their pieces into one piece of legislation. And that becomes tricky, right? So the Gold Star Family Bill, for example, is a whopping 5.5 pages. The appropriation bill that passed last year that actually not just funded the government, but did all of the major policy initiatives was 2,567 pages.
I would just like to point out that Dodd Frank was barely less than that. Like funding the entire government was just barely more than putting together Dodd Frank. But anyway, I digress. Keep going.
Yes. So, so again, I mean, I'm optimistic on that one. Again, just given the target audience, but I couldn't tell you that it's anything close to a slam dunk because there are no such things here now.
Nope.
Even funding the government is not necessarily a slam dunk.
So Kevin had a good idea a couple of years ago that I just want to throw out there, Michael, since you're in DC, and maybe you could bring it up at cocktail hour or, around the fire pit with your colleagues. He said that every time they pass a new law, they should get rid of, or a bill, they should get rid of one, right? I think that's so smart. Or was it two, Kevin? I don't remember. Anyway,
my rule was if it's not being enforced,
or
they
not
should get rid of it.
enforced. That was the additional enhancement to his law. So if you can make that happen, Michael, I think the world would be a better place. So for every law or bill that gets passed or isn't being enforced, let's just get rid of it so it simplifies things, right?
You think so, but
Yeah.
it's actually been proposed before.
Oh, really?
And
you're
it's
kidding,
been proposed before, and there was a GAO study on the feasibility of doing that. And what the GAO found was it would actually cost more money to get rid of those laws and get rid of the statutory provisions than it would be to just leave them there and not enforce them.
Oh, for God's
Wow,
sake.
that's funny.
Okay, that's disappointing. Well,
It kinda
Kevin,
makes
I
sense,
think it was a great idea. So it
Yeah.
was bupkis, but it shouldn't have been. Oh my God. Okay, just wanted to let you guys know, guess what's we have talked about how mortgage complaints were so low and that they were doing better and that there weren't very many. Guess what? We're at 41.2% in Q1, people. Now, most of it was servicing, and these are complaints to the CFPB. So mostly servicing, but it's a flip from most of the complaints prior to that were about credit reporting. And the point I want to make is the consumer is figuring out what the CFPB's role is, and they are learning how to file complaints. So watch yourself, do things the right way, always. Okay. There are, 41.2% more reasons to do that. So it is, I just found that interesting. Also just want to take a moment and talk about inflation numbers, because inflation has been the bane of our existence for over a year. And so we had CPI came out and then PPI came out. So CPI is Consumer Price Index. That went from 6% to, ready? You ready? 5%. That's down an entire percentage in a month. So core went from 5.5 to 5.6 because it includes 43% of core CPI is shelter costs. So it went up just so slightly, but those shelter costs are a lagging number. We had peaked at with 9% CPI before. Yep. We are now down to 5%. This is really, really good. Then we got PPI, which is producer price index, which that's wholesale inflation, remember? So that is way down. That was at 11.7% a year ago. And the headline came down 0.5 point. We've gone from in 1 month, well, not in 1 month, but anyway, we went from 4.9 to 2.7. We're at 2.7 year over year headline wholesale inflation. That doesn't mean that we're out of the woods yet by any stretch. Core is down just ever so slightly, but Barry Habib has been saying for months, circle May 10th.
May 9th, baby. May 9th.
May 10th, Kevin, May 10th.
Oh, May 9th. No,
Yeah.
May 9th
So
is the day you
anyway,
want to make sure you don't block.
And it won't mean that we are completely in the clear, but it does mean that we have peaked. We are now going to be replacing inflation numbers from last year with numbers probably, we can never promise, that are lower.
Much lower.
And we are in a much better spot than we were before. So just hang on a little bit longer.
Hey,
yes.
There was a couple of things that we talked about. They weren't our talking point officially because we kept it down to 4. But there was a 5th item that came up when we were talking to veterans favored Congress people. And that was getting the VA loan type for protecting vets when purchase offers are made towards buyers or sellers. And that is to eliminate the checking off the box saying it's a VA loan or FHA loan or a conventional loan. Why do we, define those differently to the seller? And that leads to borrowers being discriminated against just because they have a VA loan or just because they're doing FHA. And so, Michael, you want to talk a little bit about this issue?
Indeed. And it's amazing to me because this is something that the realtors, they're not necessarily advocating for, but they will defend against just this kind of modification. I mean, they don't want to be seen as being anti-vet, but at the same time, they want to preserve their members' ability to say to their selling clients, hey, listen, that's just going to be a hassle and you shouldn't bother with this, and you should take this deal instead because it's more conventional and you don't have to abide by all the VA or FHA requirements. There isn't anything, and it's the problem with it though is there isn't anything that you could do at a federal level. And what NAM is working on is trying to get the GAO to study how pervasive this is and how pervasive it is at the state level, right? Because I mean, that's where you really have the issues, and because that's where these folks are licensed, not the brokers themselves, but the real estate agents. So, to figure out how pervasive a problem it is and see whether or not there's anything that can be done. Just can't figure out how to actually do that outside of name and shame at the moment. But every time we talk about it, I mean, people are appalled. They're shocked that there's gambling in this casino, right? And it's like, well, yeah, this is an issue.
It's an issue.
And then they ask, what do we do? How do we fix this? Like, we don't know, right? I mean, because it's just egregious behavior, but it is not illegal to do that. And how do you tell someone, hey, you should, from a seller's perspective, you have to take an offer, even if it's a VA, or you can see where from a legal perspective that can go sideways quickly. So we're going to let the GAO sort it out and get them to do this study. That doesn't really cost anything. That is not political, Audrey. So that's one thing that's not political. You can just write a letter to the GAO and tell them to do things.
Tell people what the GAO is, Michael, because Kevin's always on my tail about not spelling out acronyms. Government. It
is the Government Accounting Office. And despite the name, despite the name.
No
They
accountants
don't
there.
just do accounting, right? They do some scoring, right? But most of what they do is research. And they figure out, they do research at agencies, they do research within the private sector to figure out whatever kind of complex or simple problem the Congress designates them to get answers on.
Well, I have a
Nice.
suggestion for what we tell our realtors, because I said this to one of mine last night. He was whining about having to take a 5% down offer instead of all cash with no contingencies. And I told him he's a big baby and he needed to get it together and understand how easy it is to close some of these loans. Then I launched into a lecture about how VA loans are great loans and FHA loans can be great loans. And he shouldn't be so lazy that he only wants to take these, little no contingencies, all cash, all this crap. I'm like, those days are over, buddy. And so it's time for you to get with the program. And so he started crying. I knew he would. No, he didn't. But again, we have to keep it real with these people. So this is something for all of the LOs on the call to do. Go educate your realtors. VA loans are not what they used to be. You don't have a seller who has to pay $1 zillion to get the loan closed. They don't take forever. There's a great process. If you get a low appraisal, there's a process for rebutting it that I swear is probably better than some of the other like if you're at a First Republic bank and you get a low appraisal, you are toast.
You're screwed. Yep.
Yeah, totally. That would be the technical term, Michael, for that Kevin just gave us.
That toast.
Anyway,
Meant toast.
VA has an amazing way to rebut an appraised value if it came in wrong. And so there are things we can do. So take this as something to put on your to-do list for the next week. You don't go to the golf course quite yet. You go educate some realtors, do a video and post it. Make sure it's compliant. Don't forget that part. Or go make an appointment with a real estate office and offer to help their realtors understand how to accept more offers from VA buyers and how good they are and how they perform and they close on time, et cetera, et cetera, et cetera. And while we're at it, throw in the fact that if you have someone who has a full credit approval, not a pre-approval, but a full credit approval, they are fine with 5% down or 3% down so that we can get our borrowers into contract. Okay. I'll take a breath. All right.
Take a
Now,
breath. While you're taking that breath, I also wanted to point out that, when you put that application, if you check conforming loan, well, conforming loan could be private money, it could be non-QM, it could be, Fannie, Freddie, and yet it's not broken down. And those all make a difference on the close, and yet it's not disclosed. So why are we picking out FHA and VA specifically? It's kind of crazy.
so Michael, I think what we're suggesting is on the contract, there should be a box where you check none of your damn business when it comes to my loan type. Okay. Can you put that on your to-do list, please?
Yeah, well, I would be interested. I'd be interested to see how that one goes over.
I know. It's worth a try, right? Okay.
I
So
think you can write that in. You just write it, none of your damn business.
we can create our own acronym, Kevin. That's it. That's it. Okay.
Hey, we did get some good news yesterday, by the way, on something coming our way in the lending world. Do you remember?
I don't remember
Or-
yesterday
or-
very well. Tell me.
It had something to do with ADUs.
Yeah,
you
keep
remember
going. Keep going. You always want to
Keep
talk.
talking.
Talk, man.
Okay. All right. So I'm just trying to hand it to you, but so we got a letter from FHFA. Am I correct that they will allow for 50% of the income coming from ADUs? This is huge in California, but in the rest of the country, it's across the board. Because I used to get people all the time.
FHA. You're thinking FHA, and it's
Is it
30%. 30%.
I heard. Well, Michael, do you want to correct me since you were there in the room and you were the one who organized the announcement? Or am I correct? It was FH. I thought I had written down FHFA 50%, but maybe FHA was 30%.
FHA is 30%.
30%. Huh. Well, my writing, I can't even read it apparently.
Either that
So-
or a hearing aid tweaked right at the wrong moment. So,
Yeah, no.
but that's true.
30%.
Kevin,
Still, 30% is better than zero.
totally.
I would have
Kevin,
liked 50%.
they're in the comment period right now. And to Kevin's point, this is really good news in the sense that we've often whined and complained that you can't use ADU income to qualify. So it's the 30% of your total income that you have to limit it to, right? Anyway.
Right. Well, yeah, but
Here's
you
what
could
we'll
use up
do.
to
Here's what we're gonna do. When they finalize that rule, we're gonna let you all know what the actual rule is.
There we go.
It's
That'll
in the
solve it.
comment period right now. We're botching the crap out of it right now. So apologies.
And it's being rapidly put through the system, so it's going to be in place pretty soon here, next couple weeks.
Well, the comment period ends in like 30 seconds, wasn't it? Like it was
That's
a
what I
really
mean.
short comment period. Like,
yeah, super short.
Yeah. So there you go. So Jill's asking ADUs on single family owner occupied property.
Yes, Jill.
I believe
That would
so.
be
I don't
correct.
know, but I don't know whether it was limited to single families or if it was unit
That I do
yours
not
too.
know. Yeah, no, I don't know that one. Well, if it's FHA,
If it's
gotta be
FHA,
single family.
yeah.
Yeah.
Excuse me, FHA does 2 to 4s. What are you talking about? Hey,
They don't allow income from other units, not
What?
from other units.
Huh?
Well, FHA will allow income from 2 units, but not 3 or
Oh,
4.
I see what you're saying. Okay, I thought you were saying they didn't do units. All right, we're moving this along, shall we? All right, so one of the people we heard from yesterday, obviously we don't know what the hell we're talking about. We're just giving you a little peek into what's coming. So we'll get you the real details, I promise. All right, so we heard from Representative Patrick McHenry, and he is the chair of the House Committee on Financial Services. Did I get all that right, Michael?
That is
Yes, you
correct.
That was close. He outlined that the three or four, you tell me, capital formation, giving form to regulating currency and data privacy. Those were his objectives, right?
Mhm.
What were your thoughts on what he had to say and how that's going to impact our industry if it does at all?
One, I don't think it will necessarily impact our industry. He was pretty sanguine about the prospects for GSE reform. He just his way of background. So he is fully gray, but he is a strapping 44-year-old. Even though he's been in Congress as long as he has, I think 19 years. He got here when he was 25 on the button. He is term limited. And so Republicans in the House, at least, decided to term limit themselves on committee. So he is in his last 2 years in leadership on that committee. So he is actually focused on getting things done, right?
Good.
So GSE reform is not going to get there because, you know, that is just a toxic waste dump of politics. And if somebody came to him and said, hey, I have this great idea and we are willing to work together, he would engage full square. But other than that, let's just leave it on the sidelines. Data privacy is huge for him. He's been on the committee for a long time, and he saw the wars back in the 14s and 15s and 16, and not being able to get a privacy agreement done in the committee. So there are two components of the privacy bill. There's the Gramm-Leach-Bliley perspective, which affects financial services industry, and then you have the Commerce Committee's jurisdiction, which is sort of in the FTC domain. They consistently come up with provisions, as they did last year. McHenry put out his own version of the bill, but it's just his views, right? It doesn't reflect the full views of other Republicans in the House or the Democrats, certainly. And the issue there is always about preemption, and it's Californians against the rest of the country. California does not want to be preempted, and I think that that's going to be a problem again. Can he square that? Maybe, if he has enough time. But of course, events always take over, right? Which is why it's so difficult to sort of keep the trains running. The Silicon Valley Bank disruption, that created its own gravity, and they had to have hearings on that, and they got sidetracked on the agenda.
Mhm.
And they're going to have to address that in some way, shape, or form from the FDIC perspective. But he still does want to do crypto. He wants to do market structure reforms there, just to put some guardrails around how that industry is going to perform and what the rules of the road are, right? So everybody understands that you don't get to pick your speed limit, and that people who invest in that also understand that there is, in fact, a speed limit. Not that everyone's going to follow it, though. So those are, I think that they're not low hanging fruit. Those are things that are definitely in the realm of possibility, and it can get done. And that's where he would prefer to spend his time. From a housing perspective, he is a major proponent of flood insurance. He and Waters have worked cooperatively together over the past 4 years to negotiate a flood bill. Their problem is not their problem is not getting the bill out of committee. Their problem is getting the bill through the House and then to the president's desk. And so he's going to continue to work on that, but he was very realistic in terms of what the prospects are for something like that. And then, you know, in sort of general housing, yes, he supports, you know, more affordable housing in theory. How do you get there? He is a small c conservative. He's not looking to spend more money and to put more money into the FHA, which he thinks is horribly bloated and inefficient, or to put more money into HUD, which the same, horribly bloated and inefficient. He would like to figure out some private sector solutions, hence, you know, getting more money into the private sector to allow them either through listings on exchanges, more benefits for investors who are going to bring some of these companies to market. Now, none of these are in the mortgage space per se, but they're in the tech space and fintech, payments. So he wants to get that going. That one, I think, on his list is probably last in terms of the realistic prospects of getting something over the finish line this year, because he and previous Republican chairman have been trying to do that for the past 13 years. And everybody is very enthusiastic about it, but it just doesn't ever pan out.
Holy smokes. Let's talk about affordable housing just for a moment, because this morning I had noticed over the years that every single time you walk into anybody in Congress or at the state level too, they're all jazzed up about affordable housing. Oh my God, we got to do something about affordable housing. It's the most important thing. Oh my God, oh my God.
Yeah. And then Audrey asked them the question.
I did.
Them, what's the question you ask them, Audrey? Is so
I said,
perfect.
so what is affordable housing to you? And literally, what was the response this morning, Kevin?
Well, first of all, her eyes glazed over. And then, yeah, we're like,
was trying to figure it out and she couldn't. There was no answer.
And then finally, we came up with, well, you know, FHA defines it as 30% of household income is the limit. Anything over that is not affordable.
Which she thought
like, well,
that number was crazy. We think it's crazy for the other reason, right?
Yeah, because none of our clients meet the 30% kind. I mean, in San Francisco where we are, I'm always pushing 45, 42s, pretty steadily on a first-time home purchase. And it's like, it's only after you in the house and you settle and your income relatively evens out, and then it starts to drift down below 30s. But for the average person, first-time home buyer, it's like you never see a 30 on a first-time purchase.
But yesterday I made a comment. I stuttered a comment to Sandra Thompson. It was so not my usual articulate. Well, I occasionally can be articulate. Yesterday was not my day. Anyway, so I managed to get a comment out to her, and I wanted her to remember that when we're pushing the ratios, the DTIs for our borrowers, it's not because there's one income and we think it's totally fine for them to, you know, have a 49% DTI and have all their money going to housing. It's because we know there's some other form of income that we're not able to count. So we feel comfortable knowing that they're going to be safe. And I don't think we can say that enough to FHFA, to the CFPB, because we're not putting people into loans they can't afford when we're doing that. And I'm not speaking for the whole world. I'm speaking for myself and the people that I talk to as far as loan officers, et cetera. We're not doing that. We're looking at the overall situation. Okay, here's your income. This is what I can use to qualify you, but I know you got all that income too, so you're going to be okay. And so again, when we're talking about FHFA implementing the 40% DTI hit to pricing, that's why that's so egregious. It's one of the reasons it's so egregious. And why would you penalize somebody just because our underwriting guidelines haven't caught up with current income sources? And we are still doing underwriting like we did when the dinosaurs walked the earth. So it's like, why would you penalize someone for that? But back to the affordable housing thing that Kevin and I were talking about this morning. Again, everybody has a different definition. And for a lot of people, it includes homeless people. It includes rentals. It includes so many things, not just, like homes that we're purchasing, right? And Kevin and I were talking about there's a glut of 1-bedroom condos in San Francisco. Nobody wants to live in them because they're too small, too expensive, whatever. Because the first-time home buyers, the cohort that is looking to buy houses right now, average age
They
is
don't want them.
6, highest ever. They want houses and yards for their families. You know what I mean? So
Yeah,
again,
they want
we
to
have a
rent a one
disconnect.
bedroom while they're, saving up money to buy the house. They don't want to buy the 1 bedroom. And so, yeah, in San Francisco, the best example is all the government programs have encouraged these developers to build all these 1 bedroom homes or condos. At the same time, you cannot find anything 2 bedroom, 1 bath home, or even a condo for that matter, anywhere to be found. It's our biggest challenge right now in the market is finding homes for the borrowers to buy, not alone getting the loan. The loan is the easy part.
But again, they think that they're solving all these problems with these one size fits all prescriptions for affordable housing. And there is no one size fits all. When you're doing it at a state level, like in California, where you have 40 million or 38 million or whatever the number is today, I mean, you've got different communities, different needs, different problems, different solutions for everywhere. And so it's a huge issue. But my suggestion is when you're going to speak to Congress, make sure you understand what they think affordable housing means before you start the conversation, because otherwise you could be talking about completely different things, right?
Yeah,
Well, it
I
depends where
agree.
they come from, right? It depends where they come from. And this is part of the disconnect, because if you have people from New York and you have folks in, California, I'm actually not even, I shouldn't say that, San Francisco, Chicago, sort of the big metropolitan areas. Yeah, I mean, you have to include renters in that discussion. That is just, sort of, foreign language to someone who is in Sheboygan, right? Like, who does that? And, or even if you go out, I mean, because if you go to sort of more suburban areas, sort of less densely populated areas, the concept of purchasing is different and the income stratuses are different. And so, everyone's going to have a different view. And I don't think it's necessary for policymakers to actually make a determination on what it is that is affordable housing. And the reason I say that is because they got burned as a part of the financial crisis in 2008, right? And if we remember, they were all in unison, Republicans, Democrats, pushing, hey, we need everybody to get into this mortgage race, right? We don't just want the private sellers doing these subprime loans. We want Fannie and Freddie in there. That just accelerated everything, right? Brought everybody down the tubes quickly, because it was this notion that everybody should have a house. And the same arguments were made during that time, but don't worry about debt to income ratio, because debt to income ratio, it'll even itself out and you get these in there. The problem was these people would get interest only loans. And if your debt to income ratio is high on an IO, and then when you start paying principal, it's you're cooked. But the people who are here, they remember that. The housing advocates, they remember that. Everyone remembers these arguments that were made. So you can see why there is some reticence to saying, hey, let's just go above that. They understand what the numbers say, but no political person is going to, go face first into that discussion again. So let's not make them. Instead, what we should be asking for is flexibility, right? We should be making sure that they're not putting downward pressure on the FHFA to limit themselves. The FHFA should have the ability to do this. Treasury should have the ability, or should be pushing to ensure that Fannie and Freddie are doing the kind of things, and you have the flexibility to get people above a certain threshold, because they're much closer to the action than the folks in Congress, because they will never understand exactly what low income means. There's not even a definition of that. There isn't a unified definition of what the debt ceiling is.
Right.
Yeah.
Hey, everybody understands generally what they're talking about, but everybody's coming at it from a different angle.
Well, I just read this article, like if you make $300,000 in New York City, it's the same as making 100,000 somewhere else, or vice versa. Like, anyway, it's like there's huge disparity with the income. I just quickly want to say that Nancy made the comment, there's a big difference when the income is lower, when you're talking about someone with less income than more. And one of the things we've talked about is residual income. And I cannot believe, is my clock right? Are we really?
It's 3 o'clock.
Are you kidding me?
Yeah.
Crap. Okay, we don't go over, so we're gonna have to wrap this thing up. I'm so bummed. We have a comment here, Michael, from Romeo, who says, great guest. First time I've heard of Michael and Googled his name. It's and by the way, he pointed out initially it shows up that you were an American Idol guest, but our contestant.
Uh-oh, they found me.
You're not the only Michael Williams on earth. That's crazy. Anyway, so we really, really appreciate you joining us today. There's so much more to talk about. It's stupid. Will you come back and join us again?
Anytime.
You would. That'd
Very
be
good.
wonderful. All right, guys, for the rest of
Thank you, Michael.
we will have Brian Stevens with the National Real Estate Post with us next week. And you never know what's going to fly out of his mouth. So that should be interesting. With all that being said, we will make this video available if you want to share it with your friends. It will be on our YouTube channel. So Michael, have a great rest of legislative conference, and we will look forward to seeing you again soon. Thank you.
Thank
Thank
you.
you, Kevin. Bye, everyone.
Thank you.